I urge you to watch my video on entry triggers before watching. Well, no, it's probably too late now, but you should still be familiar with entry triggers because it's really important. You can't trade if you don't know how to enter a trade. Okay, 3 options here. As always, I'm sure there are more, but these are the main ones, at least for this setup. Option 1 is market order on candle close through the level. Okay, so in terms of how this stacks up, in terms of pros and cons, it's a very clear trigger, but some discretion as to whether the break is impulsive enough. Okay, so it's not fully automatable, quote unquote, because you still need to decide whether the second close was impulsive enough. It's also quite aggressive. Okay, you're not waiting for pullbacks, just waiting for the level to get rinsed, and then you're involved. In terms of risk reward, it can make a trade setup inactionable if you wait for the close, because it can simply close too far from the level, right? An example of that would be, I think it was one of these charts where the close was just really far away. Yeah, so in this case, this is intraday UCAD. You have quite a big level. You've got old highs and old lows, so really big area. I'm going to be consistent and delineate it using the lowest close here. Okay, and if we're using candle close as our entry trigger, first of all, is the setup valid? Smashes below it, and then immediately smashes back above. It is valid. Nice little liquidity pool confluence as well. Okay, but at this point, if you're taking an entry here with your risk here, where's your trouble area? I mean, probably this high. If that meets your risk reward criteria, I mean, what's that? Is that 1.3R? I can't really do it by eye. But the point is, the broader point is, if you're using a candle close entry trigger, you need to still make sure the trade is actionable, because sometimes the move away will be so violent, having smashed one way and smashed the other, that it's simply too close to a reasonable target or to a trouble area for there to be a trade. Okay, so that's just something to bear in mind. Option 2 is a limit order at the broken level once the candles close through it. Okay, so this is the clearest trigger by far, because you know the level and you just leave an order at the level. It's quite conservative. Another benefit is that you can assess in advance whether the setup is actionable or not, and the only risk, it's not really a risk, is that you don't get filled or price not pulling back before it goes. And this is normal in trading. It's just called a missed trade. Okay, so some of the examples that we talked about fit to that quite nicely, including the Euro USD one, right? Same level, highest close, smashed above, smashed above, we're paying attention, smashed below, okay? And at this point, on the close of this candle, you'd leave a limit order at the level itself, which got retested. Hopefully you got a fill from your shitty broker, and then down it goes. I believe ETHUSD is very similar, though it might not be to the tick. Right, you've got a level on this next day. You have an immediate bearish setup. Close above, close below. On the daily close, your limit order goes at the level. Looks like the high of the day traded up to it, and down it goes. I think this comes close here. It certainly works out at the highs as long as you don't get stopped out. So you've got the highest close here. Again, liquidity pool confluence in the form of price trading above the swing high and taking out these stops. You can see close above, smashed it, yep. Close below, yep. Limit order goes at the level, and the next trading day comes in, taps it, and drops into support. Okay, so that's what I mean by limit order at the level. And option 3, again, is market order at the broken level once price retests it following the break. You'll know from the entry triggers video, this is basically your price action type of entry, by far the most discretionary one. And just speaking generally and from experience, if your trading style deals well with reactions at a level, you'll probably do this anyway. It just makes it a bit harder to track. But if that's how you take your entries, then I shouldn't have to explain it for you. It's really these two that tend to be the most important, and the ones that I use the most. So probability enhancers, right? Let me just take a look and make sure I've not missed, this is wrong, make sure I haven't missed anything. I think we've gone through most, if not all of these, okay? And I'm sure you can find plenty of examples yourselves. So probability enhancers, what can we do to make the setup more likely to work? First and foremost, I'd say this is probably the most important one, or at least the one without which this setup will very rarely work, is you need good level selection, okay? So that means clear, high time frame, violent and significant levels perform better than random highs and lows, okay? Don't try to force this type of setup. It will happen, but it will happen around good levels, and it will work best around good levels. And as to the actual horizontal support resistance structure itself, we're dealing with a broad church. So multi-touch levels work, as you saw, I think, on the UCAD example, single swings, inverse levels, range highs and lows, any kind of significant horizontal support resistance structure works on this setup, or works with this setup. That's the first thing, good level selection. Second thing is that the second break or break back through the level should be strong and fast, okay? As mentioned earlier when we went through the kind of reasoning, a strong and fast break means less time for those offside to mitigate and more traders trapped. When traders are trapped, the unwinding of that move or at that level tends to be violent, okay? When people are forced to make a decisions, puke their positions at a loss and all that kind of stuff, as you know from the order flow video, that's where the fast and violent moves happen. And ideally it's some sort of engulfing candle or your typical kind of bullish price action at the level. What you don't want is like a really, $2 close above the level with like a tall wick. That's not what we're looking for. We're looking for evidence of a trap, evidence of impulsiveness, evidence of people caught offside. Okay? Another factor of confluence or probability enhancer is that the first or false break spikes into liquidity, right? So as with Swissy, we saw that, where was it? Nope. Yeah. And by first break, I mean, the initial move down. So this is break number 1, and then this is break number 2, right? And so what I mean by spikes into liquidity, you can see this move down wasn't just a quote-unquote break of that level, but also anyone with stops below this swing low has been knocked out, right? And we had a couple of other examples that I'm sure you remember better than I do, but the idea is you can derive confidence from these setups when it's not only a trap or the false break at the level itself, but there's also a deep swing high, swing low, or other likely area of liquidity that the market's going for that lines up with the setup. Okay, just go back 5 minutes or however long ago that was, where we covered a couple of those examples. And last but by no means least, trend considerations are really important as always. Right? So in an uptrend, bullish setups are more likely to form and a higher probability. So with the aim of bringing in shorts for liquidity, for long liquidity, leading to upside continuation. Right? If you're uptrending, the whole market can't be right. So the way market offsets those weak hands is it'll break support, make people think they're geniuses that have just caught the top, or are going to short near the top, and then simply to blast through that same level again, leaving everybody offside. Similarly, in a downtrend, bearish setups are more likely to form and a higher probability because you're trying to get people to long in a downtrend. That's how you get your shorts filled. Okay, this is just basic trend stuff. Again, order flow video, all that good stuff. You're trying to induce people on the wrong side of the market. If the market's trending down, you quote unquote break resistance to get people in offside and fill shorts, and vice versa. Okay, so to recap, you need good levels, otherwise the setup doesn't work. Second break, the reclaim break, or whatever you want to call it, should be strong and fast. Okay, extra bit of confluence, though it's not a necessity, so I'd say this is a prerequisite, as is this. This is just quite nice if it's the case, that there's a kind of liquidity pool or area of liquidity that has confluence with the false break. Okay, it just simply adds to the idea that more people are trapped. And as with anything, read my article on directional bias. Whatever tools you use, trend considerations are always important. You're going to have a lot more fun and a lot more success taking bear trap setups in a bull market, I think that's correct, and doing so vice versa, right? Conclusion. When it comes to any setup, my suggestion is that you forget the special name it gets and focus more on the logic that it employs. That's what we did at the beginning. We said that all these fancy sounding setups have the same logic. It's support, resistance, flip, failure. And once we get down to the actual price mechanics and price patterns, that's where we can study it, refine it, and make it our own. Okay? Please don't get married to the names. For the most part, if you're a discretionary price action trader, the structures and the systems you're taught are pretty much all the same. It's the marketing that's different. Okay, so get rid of all of that. Focus on the price pattern. That's where you're going to find your setups and probably your edge, or at least a big part of your edge when it comes to trade identification. This is how I've had the most success trading price action, where essentially an SR flip has failed. Okay, there's no wizardry here, just losing money on stuff that sometimes works. There's probably a setup in the other direction, right? So if you forget this whole lesson, for example, if you have a setup where you lose money, just check what the market does once you get stopped out. If it really, aggressively reverses, there's probably a good chance that you can reverse engineer something out of that to flip long or to flip short from your original setup. Okay? As with most discretionary technical trading tools, setups will work best in the appropriate context, so that's this kind of stuff, especially trend, and where the structure is exceedingly clear. It's really tempting, and I know the feelings have been there, when you learn a new tool to try to curve fit or to find it immediately, try to find a trade as soon as possible, but if you have to really look for it, it's probably not there. And as you'll hopefully see or have seen from the examples we went over, all of those levels were really, really good, clean, significant, violent technical structures. Okay, and that's something to always keep in the front of your mind, especially given the criterion of good level selection. And nothing works all the time. Look to find something that makes sense to you, stands out on the chart, occurs frequently enough to trade in the markets you trade, and bears a positive expectancy in your robust testing. I mean, that kind of speaks for itself. Res ipsa loquitur.